Good morning, everyone. I know it's been a long morning, so I want to thank you all for spending part of your day with us and for your continued support of Intuit. We're almost to the end. I'm the last one before Q&A, so just hang in there with us. I also wanted to say, I've spoken to a number of you. It's really great to see people in person again, so thank you all for attending. Today, I'm going to share how our global AI-driven expert platform, our strategy there, translates into our financial results and how our financial principles continue to guide our thinking. Similar to what I've done in the past, I'm going to start with a look back. So you'll see on the left side of the slide, you'll see the key objectives that we outlined at last year's Investor Day. And on the right side, it shows how we performed against those objectives. Our performance in 2022 was strong across each of our businesses, and we achieved our goal of double-digit revenue growth with 32% growth at the company level, including the addition of MailChimp and a full year of Credit Karma. Excluding MailChimp, revenue grew 24%. Our combined platform revenue, which includes small business and self-employed group online ecosystem, TurboTax Online, and Credit Karma revenue, grew 45% in FY22. And that was 34% excluding MailChimp. We grew GAAP operating income by 3% and non-GAAP operating income by 29% for the year. And we also remain pleased with the consistent increase in our dividends, and our ROIC reflects the acquisition of MailChimp. Now, we use our financial principles to guide the decisions that we make. So let me provide a little bit more color here on each of these. First is to grow organic revenue double digits. We continue to see large opportunity ahead as we expand the set of customer problems that we address through a broader set of products and services. Next, we focus on growing operating income dollars faster than revenue. It's good discipline for us, each year to approach the new year with the idea that expenses are growing slower than revenue. We do expect to see margin expansion this year and continuing over time. Next, we deploy cash to the highest yield opportunities. Whether we're looking to expand into new products and services, considering acquisitions, or as we invest more deeply into our technology platform, we target a 15% ROI over 5 years. The threshold is really key to us making sure that all investments will deliver for years to come. After this, we return excess cash to shareholders. This speaks to our stewardship of how we handle the capital that we generate and comes in the form of buybacks and dividends. And then finally, we manage to a conservative investment-grade balance sheet that can really sustain our business through all types of economic cycles, including something like the uncertain macro environment that we see today. A moment ago, I shared that our combined platform revenue is driving our growth, and we expect that this will remain the case going forward. In 3 years, we expect more than 80% of our revenue to come from these offerings. We'll also continue to support our customers who are using our desktop offerings. And as we've shared before, we have a highly predictable recurring revenue model. Approximately 80% of small business and self-employed group revenue is subscription-based, and that's including our desktop accounting offerings. We also expect more than 80% of our revenue this year to come from existing customers. Customer growth remains an important part of our strategy across all of our businesses. And so starting with SBSEG, on the left side of the slide here, you'll see total paying customers. This includes online paying customers and desktop accounting subscribers. With the addition of MailChimp, we're updating our online customer definition, as Alex mentioned, and that's beyond just QBO subscribers. We're now including standalone services customers who subscribe to a service that is not connected to QBO, and MailChimp paying customers as online paying customers. And as a reminder, in the fall of 2021, we made a decision to transition to a subscription model for our desktop lineup with the 2022 release. And so we're selling our desktop accounting offerings as a subscription only and no longer selling desktop units. Our desktop base remains relatively sticky, but we continue to see the majority of customers who are new to QuickBooks choosing QuickBooks Online. On the right side of the slide, you'll see that we grew QuickBooks Online ecosystem ARPC by 24% and online paying ARPC by 37%. Looking ahead, the addition of MailChimp really provides significant ARPC growth opportunities as we build a single platform where small businesses can run and grow their businesses. And as Alex shared earlier, we're well on our way to becoming the source of truth for more small businesses. We still have a large runway ahead with small businesses and mid-markets, with those customers in the US, as well as internationally as we execute on our acceleration priorities with MailChimp. Now, moving on to the consumer group, we continue to see traction with our goal of growing our share of total tax returns. We're pleased with growing our share of total returns despite total IRS returns declining about 1%. We also grew average revenue per return again this season, and we continued to transform the $21 billion assisted segment with TurboTax Live. And we achieved a significant milestone this year with TurboTax Live revenue reaching $1 billion, growing about 30%, and TurboTax Live customers growing 20%. As Varun mentioned earlier, we continue to see plenty of runway ahead as we transform the assisted segment, double down on underpenetrated segments, and expand our TAM by $10 billion to pursue business tax. Moving on to Credit Karma, we have a large $85 billion TAM across the 3 verticals that Ken talked about. We grew our share of credit card and personal loan transactions on the platform to 7% and have a significant opportunity to increase penetration in each of the 3 verticals. The business finished this year with a revenue growth of 58% year over year on a pro forma basis. That's driven by both credit cards and personal loans. And the team is really focused on continuing to drive growth through innovation. On the right side, you'll see the key drivers of Credit Karma's revenue growth. As we innovate for our members and beyond core verticals and into growth and emerging verticals, we expect to drive higher member engagement and higher average revenue per monthly active user. Now, everything we do, as Sasan mentioned earlier, everything we do is really customer back, and across all of our businesses, we're able to improve monetization as we accelerate innovation and increase the value we're providing to our customers. ARPC is not something that we manage to. It's really the output of the various decisions that we make regarding customer and revenue growth. This year, again, we saw an increase in our ARPC across all of our businesses. Starting with small business, you'll see that we have provided historical data for ARPC for our online paying customers. Going forward, we expect online paying ARPC to increase. And this is really due to our maturing customer base, increased monetization via online services, including MailChimp, which has a higher ARPC than QuickBooks, and higher value offerings like QBO Advanced and QuickBooks Live. Turning to QuickBooks Desktop, we expect ARPC to increase due to the mix shift of customers from outright units to subscriptions and enterprise growth. And in the consumer segment, we expect to see an increase in ARPR as we continue to transform the assisted category. For Credit Karma, we expect ARPC to increase due to more engagement, as Ken mentioned, and that's engagement by our members, and then also the share gains within the core verticals, as well as scaling the growth and emerging verticals. Durable revenue growth and disciplined investment have driven our operating income growth historically, and we remain focused on both going forward. On this slide, you'll see our long-term expectations for the P&L. We expect each of the expense lines to be flat or flat to down as a percentage of revenue over time, as our platform evolution enables new drivers of operating margin expansion. Fiscal 2022 operating income grew slower than revenue due to investments we made in stock-based compensation and the impact of Credit Karma and MailChimp acquisitions. In fiscal 2023, we expect GAAP operating income will grow slower than revenue due to these investments, but our non-GAAP operating income will grow faster than revenue. At a high level, our approach to investment has not changed. We invest in the highest yielding opportunities with a focus to drive durable growth and accelerating speed, all within the context of our financial principles. We continue to prioritize investments in our big bets, and we'll continue allocating a large portion of our investment dollars into these areas to drive durable growth over the long term, while being very deliberate about expenses in core innovation and running the business. A key element of our financial principles is to grow operating income dollars faster than revenue. And as we lean into our platform strategy, we expect to continue to expand margins this year and over time. As Mariana mentioned in her presentation, we're increasing the velocity of development on the platform to deliver even faster benefits for customers across all of our products and services. This includes our AI capabilities, our expert services, money movement, data exchange, and fraud and risk capabilities. We're scaling our customer success platform across our products and services to more efficiently serve our customers by leveraging AI. And our go-to-market capabilities leverage a common infrastructure to effectively target and manage the sales and marketing process efficiently. Now, we have a solid track record of margin expansion on a non-GAAP basis, from 33.6% in FY19 to 35.4% in FY22, even with the additions of Credit Karma and MailChimp in fiscal 2021 and 2022, respectively. And we're guiding to non-GAAP operating margin expansion of approximately 100 basis points for fiscal 2023. As I mentioned on the Q4 earnings call, our fiscal 2023 guidance includes stock-based compensation of $1.8 billion, which is an increase of 39% over last year. Approximately 25% of this total is equity that was granted as part of the Credit Karma and MailChimp transactions, and approximately 75% of this is related to our broad-based equity program that's really designed to attract and retain and incentivize our employees. Looking ahead, we expect stock-based compensation as a percentage of revenue to flatten over the next few years from the 12% that is embedded in our FY23 guidance. Note that the transaction-based grants largely vest over 3 or 4 years and will therefore be included in expense for a few years yet. We're confident, though, that our decisions around stock-based compensation are the right decisions to attract and retain great talent and drive long-term growth. It's important for us to be effective stewards of capital, and this includes investments in organic growth drivers as well as acquisitions to accelerate progress against our strategy. Over the last 4 years, we've returned about $6 billion to our shareholders through share repurchases and dividends. We repurchased approximately $2 billion in shares during FY22, and I'll touch more on repurchases in a minute, as it remains an important tool to return capital that can't be invested profitably in the business. As for dividends, our board declared a 15% increase in the dividend for fiscal 2023. So our philosophy and principles on share repurchase remain consistent with what we've shared in the past. We limit repurchases to cash that can't be profitably invested in the business or used to make prudent acquisitions. We apply rigor to this process by utilizing a smart grid to drive various levels of repurchases at each price range. And it's really with the goal to exceed our cost of capital on average. At a minimum, we expect to offset dilution from stock-based compensation over a 3-year period. And subject to market conditions and other factors, our aim is to be in the market every quarter. We're a data-driven company, and we review external indicators as well as our own internal KPIs on a regular basis to keep close to market and macro trends. As Hassan mentioned earlier, we have an Intuit operating system, and we begin with an external look at the macro environment, which informs our 6-year goals and our 3-year plans. The scale of our platform, along with our rich data on both small businesses and consumers, gives us a unique ability to monitor leading indicators as well as our own internal KPIs on a daily and weekly basis. And this really allows us to be more forward-looking and adjust very quickly. The operating system we use to run the company includes a proven playbook for operating in both good and in difficult economic times. Our first priority is to do the right thing for customers, giving them access to the tools and offerings that they really need most. Second, we manage for the short and long term and control discretionary spend to deliver strong results and maintain earnings power. And third, we play offense by investing aggressively in the largest opportunities for the future. Now, these principles are intended to accelerate our innovation in the future, and our goal remains for Intuit to emerge from any economic cycle in a position of strength. Now, looking ahead, we're pleased to be guiding double-digit revenue growth of 14 to 16% for the company in fiscal 2023. This guidance is what we released back in in August, so there's no changes here. Although you will see that we changed the name of the ProConnect group, and it is now the ProTax group. The guidance for operating income and EPS are also unchanged since August. We exited FY22 with real momentum, and we expect this to continue as we make our way through fiscal 2023. We remain focused on making the right investments to drive durable growth across our businesses. With that context, our long-term expectations for Consumer Group and Credit Karma revenue growth are unchanged, as Varun and Ken shared earlier. And as we highlighted on our earnings call last month, we now expect small business and self-employed long-term revenue growth of 15 to 20%, which is up from 10 to 15% previously. And we're no longer providing specific online ecosystem goals. We expect growth to come from 10 to 20% increase in online paying customers and online paying ARPC. We don't expect the desktop ecosystem to be a growth driver for the long term. So in summary, fiscal 2022 was a dynamic year for Intuit, and we're well positioned to continue our strong performance for fiscal 2023 and beyond. Our AI-driven expert platform unlocks opportunities to better serve customers across all of our businesses as we focus on offering them the products and services that solve their biggest problems. And I look forward to connecting with you all throughout the year and keeping you appraised of our progress.